How to Trade in Stocks, Jesse Livermore. A novelist told Jesse Livermore's story in the 1920s, and it became the most loved trading book ever written. Then, in 1940, near the end of a 40-year career, Livermore sat down and wrote the manual himself. How to Trade in Stocks is short, blunt, and unsentimental, less a system than a code of patience built on one conviction. The market's verdict is final, and the opinion most likely to be wrong is your own. Core thesis. Livermore's starting point is that speculation is a business, and it must be run like one, with capital protected, records kept, and rules obeyed. Treated as a daily gamble, it behaves like one, and the house wins. Inside that business, the master variable is time, not what to buy, but precisely when. Livermore insists a trader can be completely right about a market's destination and still lose money by acting too early. Because the market can take weeks to confirm what the trader already believes, and the waiting shakes out everyone who arrived ahead of the move. His remedy is brutal in its simplicity. Hold the opinion, withhold the money. Commit only at the moment when price itself declares that the move has begun, and expect only a handful of such moments in an entire year. Everything between them is study and patience, and doing nothing is itself a position, held while the impatient fund your next opportunity. The pivotal point. Livermore's practical tool for finding that moment is what he called the pivotal point. In one form, it marks the turn of a major trend, the place where a long decline finally ends and a new advance begins. In the other, it forms inside an existing trend, a pause or consolidation from which price breaks out and confirms that the move still has force behind it. The rule at a pivotal point is to do nothing until price behaves correctly there. If a market returns to a level where it turned before, it should either break decisively through it or visibly refuse, and each outcome dictates the action. A clean break means go with it. A firm refusal means the old force still holds, and the bounce is the trade. What is never allowed is guessing in advance. The pivotal point is a place to watch, not a place to predict, and acting only on its resolution gave Livermore entries so close to the start of real moves that the market handed him an early cushion of profit, which is exactly what makes patience affordable later. Osiris Capital Trading Desk speaks in this same grammar. Its calls are conditional by design. If the level breaks, the entry is here, the stop is there, and the target is beyond. If it does not break, the answer is to wait. A level is treated as a question the market has not yet answered, and the coaching begins only when the answer prints. The line of least resistance. Beneath the pivotal point sits a principle that offends every bargain hunting instinct. Price follows its line of least resistance, and the trader's job is to wait until the market declares which way that line runs, then go with it. So Livermore bought strength, the new high made after a normal rest inside an uptrend, and he sold weakness. He refused to buy something merely because it had fallen and looked cheap, and refused to short something merely because it had risen and looked dear, because both are arguments with the market rather than agreements with it. Conviction, he insisted, is worthless until price acts in accordance with it. The crowd buys falling markets hoping for the turn and fades rising ones certain they have gone too far, and the crowd pays for it. The professional waits for confirmation, then follows. Trade the leaders, read the sisters. Livermore concentrated on a handful of leading names in the dominant groups of his day, on the logic that if you cannot make money in the strongest movers, you will not make it anywhere, and that watching too many markets produces confusion rather than insight. Within a group, he read the sister names, the companions that ought to move together. A breakout in one, confirmed by its sisters, was trustworthy. A solo move the rest of the group refused to follow was suspect. He also confessed the opposite error from his own record, assuming that because one group had topped, everything must be sold at once. Each market turns on its own schedule, and each must be allowed to give its own signal. The leaders themselves rotate over time, so the work of identifying what is actually leading now never ends. Sit tight when you are right. The most famous lesson in the book is the one Livermore paid the most to learn. His great fortunes came not from clever entries, but from sitting still on a correct position while it ran its full course. Being right was necessary. Staying seated was what got paid. He is merciless about the amateur reflex that destroys this. A position bought well jumps to a quick profit, and fear of giving the gain back floods in, so the trader banks a small win at the exact moment the evidence argues for holding. Livermore reads the same moment the other way around. A market behaving that well is the confirmation. The paper profit is the market's own statement that you are right. And as long as the position keeps acting right, there is no reason to hurry out. Sitting is not passivity. It is the active refusal to let ordinary fluctuations talk you out of an extraordinary position. Cut losses fast and never average down. The mirror rule is just as absolute. Losses are taken quickly and small, and a losing position is never added to. Profits, Livermore observed, generally take care of themselves, while losses left unattended only grow. The first small loss is a premium paid for insurance against the catastrophic one, and a speculator must act as their own underwriter. He dismantles averaging down with plain arithmetic. Buy at 50, add at 47, add again at 44. And you are committing ever more capital to a position the market keeps telling you is wrong. If the method were sound, you would be obliged to keep doubling all the way to the bottom, and no account survives that policy. He adds one piece of black humor that has aged perfectly. The margin call is the only reliable tip a broker will ever give you, because it means you are on the wrong side. And the correct response is to get out, not to send good money after bad. And when a position stops acting right, the danger signal is honored immediately. The trader who resolves to exit on the next rally talks themselves back in when the rally arrives. Courage in this book means obeying the signal the moment it appears rather than opening negotiations with it. Probe first, pyramid the proof. Livermore rarely committed his full size in one stroke. He opened with a probe, a fraction of the intended position, sent out to test whether the market agreed with him. Only as the trade showed profit and kept acting right did he add. So his line grew in proportion to the evidence, and his average price rose as conviction was earned. A failed probe cost little and was cut fast. A confirmed one was pressed hard. That is the disciplined opposite of averaging down. Capital is fed to the positions the market is rewarding and starved from the ones it is punishing. So the trader's largest exposure always sits in the trades that have already proven themselves. When Osiris desk supports pressing a winner, it holds this exact shape with you. Each addition earned by confirmation, each one smaller than the last. And the whole line protected under a single composite stop, so the pyramid stays a monument to being right rather than a bet on being rescued. Guard the capital, bank the wins. Livermore treats cash the way a merchant treats stock in trade. Run out and you are out of business, whatever your talents. So the rules are plain. Risk only a limited amount on any single venture. Never be fully committed, because a trader with no reserve is helpless exactly when opportunity appears. And after a genuinely successful campaign, take a share of the profit out of the account entirely. Money sitting at the broker never feels real and slides back across the table, while money physically set aside becomes tangible, and a trader who has banked something real takes fewer reckless chances. His last warning under this heading is about speed. The trader who tries to multiply an account in months rather than years is forced into oversized positions and eventually meets the one drastic move that ends the story. The market pays patience compound interest and charges impatience a lump sum. Hope and fear installed backwards. Livermore names the enemies plainly: hope, fear, greed, and ignorance, and then makes the observation that explains most losing careers. Amateurs feel hope and fear in exactly the wrong order. When a position moves against them, the moment for honest fear, they hope instead, telling themselves the loss is temporary. When a position moves in their favor, the moment for hope and courage, they grow afraid and snatch the small profit. Invert those two feelings, fear the loss early and hope with the winner, and most of professional trading is already done. His remedy is never willpower, it is method, a predefined set of rules that makes the decision before the emotion arrives. So the trade is executed by the plan rather than by the feeling of the moment. This is also where a live mentor earns its place. When you are offside, Osiris Desk's coaching turns quieter and firmer, pointed at the exit the plan already chose. When you are onside, it argues for patience against the itch to bank early, holding the inverted instincts in place until they become your own. Keep your own records. The engine under the whole method is record keeping. Livermore wrote his key prices down by hand, in his own structured format, and insisted the work could not be delegated, because the insight lives in the act of keeping the record. His columns of trends, rallies, and reactions existed to make the time element visible, stripping away the daily noise until the shape of a real move stood out plainly. And the records themselves supplied the detachment that a mind glued to the ticker loses. He loved the story of a trader who lived far from the exchange, received his prices days late, traded only a few times a year, and prospered precisely because distance forced him to see shapes instead of wiggles. Bottom line. Read this alongside the famous novel of Livermore's life, and the two books complete each other. That one is the story, this one is the manual. Wait for the pivotal point. Follow the line of least resistance instead of arguing with it. Trade the leaders, sit tight on the winners, cut the losers without negotiation. Pyramid only what proves itself. Guard the capital, and keep records honest enough to convict you. It is a short book because the truth is short. The discipline is the hard part, and it is the only part that pays. Few habits separate the professional from the crowd as plainly as whether rules this simple actually survive a losing week. Keeping rules this simple intact is a large part of what Osiris Desk is for, an advanced platform for trader development and disciplined trade management, and the flagship of Osiris Capital. None of that survival is left to willpower, because Osiris Desk carries this very book onto the desk, trade after trade. It waits at the pivotal points with you, speaks only when price answers, presses what proves itself, and cuts what does not, until trading on the market's terms is simply how you trade.